All right, here we go. Friday, May 31st, end of the month. Trade fears, trade wars. It's a story we've been talking about now for over a year. So last night, actually yesterday, the market started to recover. We had a bottom in place. Monetary conditions were such that, and I still believe they're such that we're going to see support come in. Now, last night, Trump said he was going to put a tariff of 5% on all goods coming in from Mexico. I believe Mexico is our second or third largest source of goods coming into the United States. You've got Canada number one, maybe China two, Mexico three, or I could have that order, I might have that wrong, I don't know, but Mexico's right up there. So of course when he said this, there was the usual reaction, the reflex reaction of instant selling. It manifested instantly last night in futures. And we are down today, and actually we are down about the same we were last night in futures. I think Dow futures were down over 200. We're down over 200 right now as I make this video on Friday midday. I don't know where it's going to close, but Friday midday we are down 200. Now, I have been all through the trade war numbers and calculus, all right? Trade is not a big percent of our GDP. Now I understand there's all kinds of supply chain relationships and you know, there are companies that are going to be affected. What Trump is trying to do here, I understand completely. I'm not judging it good or bad. It is sort of a reconstruction, if you will. Longer term, it's a reconstruction or a recomposition of our economy. The wealth is not lost into outer space. As I have explained in the past, if you look at a relationship, let's say, between the United States and China, and you look at the tariff situation, what happens? The United States gets fewer goods and more income, and China gets more goods and fewer income. So it's a redistribution. The wealth, it's the same amount of goods, they're just produced in different locations. It's the same amount of monetary wealth, just someone gets a little bit more, somebody gets a little bit less, but the quantity of goods that equates to that amount of wealth, financial wealth, or money if you want to call it, is exactly the same. So it's a recomposition. The wealth doesn't go out into outer space. This is not the destruction of anything. It is not a war. The use of the term war is a very bad term. I mean, in war, capital is destroyed. Physical capital is destroyed. We blow things up. Human capital is destroyed. People get killed. That is loss. Let us understand something. That is loss. Okay? If your country is bombed, or if we bomb another country and their means of production is taken out, it's destroyed, and the labor force is killed, yeah, that is lost wealth. But we are not talking about that here. Okay, that's point number one. So, and tied in with that point, I continue to say that these reactions to these developments are complete and utter overreactions, emotional panic reactions. Now, let's go to where we are as far as the market averages. Let's look at the S&P. The S&P, and by the way, not that I really have to repeat this, but I will. We had this trade war scare back in November and December, and the market had a decent sized correction, and I said back then, you got to buy into that correction. I said it was going to go to new all-time highs. We went to new all-time highs. We are down about 7% in the S&P from the high that we hit in April. Okay? We are up 19% from the bottom in late December. That was the Christmas Eve bottom. 19% up. Now we are 19% up in spite of the tariffs, the trade war threats, real or imagined, and everything else going on. You got impeachment talk, you got all kinds of stuff going on. We are up 19%. We're 7% down from the highs. With everything, this includes today's correction, where we are today. We're about, what, 2750, 2760 on the S&P. We're not even, if you think about it, we didn't even do a 38.2%. That would be like a Fibonacci 38.2% retracement from the high. We hit it was 2961 on the S&P futures. I don't know. So now we're not even down to that first level retracement, let alone a 50% retracement or 61.8% retracement. We didn't even get to the 38.2% retracement yet. So these are some things that I wanted to cover. These are some things that I wanted to say. I'll bring up another point. And maybe this has no meaning or no relevance right now, but I'll put it out there. This is the first time that we have not seen the dollar move higher in response to trade war, panic, market sell-offs, etc. The dollar is moving lower. Now again, this might not have any relevance. It might move higher next week. We got things coming out next week. We got an ECB meeting, and we have Reserve Bank of Australia meeting where a rate cut is expected to happen. Okay, so potentially we could see a big decline in the Australian dollar, and I would think that other currencies would fall in sympathy. But that's happening next week. We'll see. I'm just saying today, in response to, and this is a new front that has been opened, if I could use that, because if we're using the term war, I'll say this is a new front that has been opened in the global, U.S. against the global economy trade war. This is against Mexico. It throws into question the whole Mexico, U.S., Canada, the new trade deal that was agreed upon. So this is big. This is big. The dollar is not moving higher. Now, final point on the bond market, which I have gone over this a number of times, but I will repeat it. And I'm going on record here, and I said if I am wrong, I open myself up to every kind of criticism and attack that you feel I deserve. But I am saying that the decline in bond yields, which started before all of this happened, the decline in bond yields is technical and related to three things now, but mainly two things. Number one is the debt ceiling. The debt ceiling makes it unable for the government to issue new securities, and treasuries are the most ubiquitous and the most sought after collateral in the world. And that debt ceiling makes it impossible for the government to issue more treasuries, which institutions and investors and savers all over the world, they need those things, okay? Very important collateral, the most important collateral in the world. All right, there's a limit on that now imposed by an artificial constraint, which is the debt ceiling. That's eventually going to get raised. It has to. That was point number one. All right? Point number two, in the last month, because of the record amount of tax revenues taken in by the federal government, there has been an enormous drawdown in bank reserves, and I have gone through this. Bank reserves are tier 1 bank assets. When those assets go down, the banks have to replace them because they are subject to regulatory requirements, stress tests, where they need certain quantities of tier 1 assets to pass those stress tests. So the banks have to replace them with treasuries. So you see, the problem is They got to buy the treasuries because we had an enormous drawdown in bank reserves. But there's no new treasuries. The debt ceiling. This is a unique situation. And the third point, which just basically came about now in the last, couple of weeks, is this kind of panic, speculative buying of treasuries, which is just, throwing gasoline on that technical condition that was there before. So I'm saying it has nothing to do with recession. I do not think we are going to go into a recession. I do not think the trade so-called war destroys wealth. It's a rearrangement, and I'm sticking by that. So yes, I am buying into this decline and keeping my eyes on everything else. And by the way, I did want to talk about the oil situation. But I sent that out yesterday to my subscribers in my weekly EIA analysis. If you want to get that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. All right, everybody, have a great weekend. Bye-bye.